What does that mean for markets? We also spoke with a lot of market experts on what they make of this thumping majority for the BJP as well as the expectations from the government. Listen in.
It's not so much that the government previously has not been emphasizing that. The problem is the hurdles in getting things done, actually. I think that's what they have to emphasize. They've got great plans. Now they've got to really push on getting things done and moving the process along more quickly. That's the first thing. The second most important thing, I believe, is reforming the labor market. Labor laws are too restrictive. As you know, anybody with over 100 workers got really lots of problems at the state level. And that has to be changed because unemployment is too high in India. There are too many people looking for work. The third thing, I believe, is just a general streamlining of the bureaucracy in every direction so that the incredible entrepreneurial spirit of the Indians can come forward.
There's a difference between the election promise, the election mandate, the coalition dynamics, and actual execution on the ground. We will have to wait and see whether it makes an impact. I think that the government can do quite a bit, but ultimately it's the economics of the businesses themselves that lead to success. So we are generally insulated against stocks that are too dependent or too sensitive to government policy. We prefer stocks, businesses which have a stronger influence in their own destiny.
The government will have to have some emergency measures for the NBFC crisis. Can liquidity or putting a window for liquidity so that they can refinance themselves, solve it? I'm not sure about that. But if you want the market's opinion on this, I think that's the number one worry, even over who the next finance minister will be, because that is absolutely stifling economic activity. There's loan aversion, there's risk aversion. So my feeling is that any finance minister would have to reassure the market that the government is cognizant and moving rapidly to try and contain the NBFC crisis.
With elections out of the way, there is going to be a lot more confidence, and the measures could be bolder and could be much more focused on improving the economy with also maybe some bold reforms on the public sector as well. I think definitely domestic economy sensitive stocks should do better. It'll obviously have to be company specific, but wherever there's value and things have been beaten down more are probably the areas where you'll see the most upside.
All right, so that was some expert opinion coming in on the markets, the way ahead after the thumping majority of the Modi government. But let's take a look at the Asian markets now. They're trading lower as investors remain worried over trade tensions between the United States and China. Remember, China is now taking a stronger tone in its rhetoric towards the US Ministry of Commerce. Spokesperson Gao Feng said that if the US would like to keep negotiating, it should with sincerity and adjust its wrong actions. Only then can talks continue. Though as we speak, the major Asian indices, the likes of Nikkei as well as the Korean market, Straits and Taiwan, they are off the lows. So the Nikkei, which was at one point lower by about 1%, is now pared its losses just to about 0.4%. Same as the case for the Korean market, and we have the Straits as well as the Taiwanese indices up for you on the screen, which have now turned into the green. Talking about turning into the green, the SGX Nifty, that one actually indicates a fairly positive start, a bump up of close to 65-70 points. There are a couple of reasons. The first one, of course, is that political stability, the big majority that the NDA has gotten in its second time around. And secondly, more importantly, crude prices, they have also reduced. Remember, all of last week, they were trading upwards of $70 per barrel, briefly also hitting $72, $73 per barrel. And now as we speak, the Brent chart should come up for you. We have them trading around $68 per barrel. So positive for India.
All right, so that was all of the action from Asia. Let's also take a look at how Wall Street fared yesterday. US stocks ended lower as US-China trade war fears lingered. The Dow Jones fell around 280 points. The S&P 500 was also around 1% lower, while the Nasdaq dropped 1.5%. Now, the Dow actually fell more than 400 points at its lows, but it did manage to regain some of its losses in the final hour of trading. CNBC's Rahil Solomon now gets us a wrap of all of the action on Wall Street.
U.S. stocks finishing in the red, though well off their session lows. The Dow down 286 points. The S&P off 34 and the Nasdaq slipping 122 points. Escalating trade tensions triggering that global sell-off today. China taking a hardline approach towards the U.S., saying trade negotiations cannot continue until the U.S. addresses its wrong actions. China did not reference specific actions taken by the U.S., but the comments come as the U.S. prepares another round of tariffs on Chinese goods and after the U.S. blacklisted Huawei, a Chinese telecom company. Meanwhile, U.S. manufacturing activity growing in May at its slowest pace since September 2009. That's according to IHS Markit. U.S. overall business activity growth also falling to a 3-year low. The report cites trade uncertainty as one of the concerns resulting in the weak data. Acting head of the Federal Aviation Administration telling CNBC there is no need for airlines to extend 737 MAX flight cancellations, though he also did not give a timeline on when the grounding of that plane would be lifted. The popular Boeing planes were grounded in March after 2 fatal crashes killed a total of 346 people. American, United, and Southwest have all had to cancel thousands of flights through the summer as a result. And that is the action from the U.S. market. Back to you in Mumbai.
All right, so that's about U.S. markets across the Atlantic. European markets, they closed sharply lower amid the ongoing U.S.-China trade concerns. Remember, the European markets did also underperform the Wall Street, primarily because when the Wall Street was still trading, the European market shut at the low point of the day when the Dow was 400 points lower. After that, we saw that recovery on Wall Street, but the European markets, they were shut for trade. About 1.5% and a little more shaved off for both the CAC as well as the DAX. The FTSE losing about 1.5%. It was the auto sector which was the worst performing in Europe, lower by about 3%, as a result of which the German index was the underperformer. Car maker Daimler was the biggest loser in the sector, down almost 7%. And in the UK, Brexit uncertainty continues to weigh, with pressure mounting on Theresa May to resign perhaps as early as today. So something is on the boil. We will watch out for that. And as a result of that, in fact, a couple of stocks took the punishment on the FTSE as well. Royal Mail, that one fell to a record low by about 11%, as there were fears that owing to this turmoil, the private courier may now be re-nationalized. So as a result of which, we saw a few accidents in individual stocks, and across the European markets, of course, weighed in by the lower Wall Street prices. We saw concerns out there.
All right, so let's also take a look at the currency space now. The dollar index eases versus the basket of major currencies now. So while safe haven Japanese yen has also strengthened on the escalation of trade warfares.
In the world of commodities, oil prices plunge on fears of prolonged US-China trade wars that could weaken fuel demand, rising oil inventories in the United States, and that also weighed on the prices.